Hello everyone. I am Rajvi and today I am joined by Kalyani, Parth and Shlok, and we are going to decode investment ideas from You Can Be a Stock Market Genius written by Joel Greenblatt. Further, we'll be discussing updates on current affairs and we'll be concluding with key economic indicators. So without further ado, let's get started with the book. Let's look at spin-offs and understand how they create value for investors. Most investors try to make money by predicting the future. They predict growth, earnings, interest rates, markets. But some of the best investing opportunity doesn't come from prediction at all. They come from companies changing their structure. Today I'll explain you how spin-offs and partial spin-offs work, why companies choose to do them, why pricing goes wrong during these events, and how simple logic can reveal hidden values. Let's start with a basic question. Why would a company do a spin-off? From a business perspective, spin-off usually happens for several reasons. Many large companies run very different businesses under one roof. For example, one company is running retail, insurance, finance, real estate, etc. This makes the company hard to analyze and hard to manage. Separating them makes each business easier to understand, value, and operate. When a business sits inside a large group, management performance is hard to judge. After a spin off, management is evaluated on one business and compensation is directly linked to the results. Often, a strong business is hidden inside a large, slower, or messier company. When everything is combined, the market applies one average valuation. A spin off forces the market to value each business separately. Different businesses need different strategies. Separating them allows capital to be allocated more efficiently. So, from the company's side, spin offs often are about clarity, accountability, and value. Now, let's look at this from the investor's side. A spin off often happens when a company separates one of its business and distributes shares of that business directly to existing shareholders. Earlier, you owned one company. After the spin off, you will own two. You don't buy anything extra, you simply receive shares. Here's the key insight. Spin-offs don't create opportunity because the business is amazing. They create opportunity because selling is forced. Large institutional investors automatically receive shares of the new company, but many of them cannot hold those shares because of the size limit or maybe sector rules, mandates, or index restrictions. So even if they understand the value, they still sell it. They sell not because the business is bad, but because they have no choice. The forced selling pushes price down. At the same time, most individual investors don't step in because these situation looks boring, complicated, or requires efforts. This leads to an important clarification. An opportunity doesn't disappear just because it is understandable. Even when the value is visible, institutions may understand it but cannot take part in it. Individual investors can act but won't analyze. Most people don't break the company into parts. They don't understand how to get the value. They don't ask, what am I actually paying for the remaining business? So the opportunity exists not because nobody understands, but because many are forced to sell or most won't do the analysis part or work. That combination creates mispricing. Now let's move to the most powerful structure, a partial spin-off. In a partial spin-off, a company separates one part of a business. A portion of a subsidiary is listed or sold, while the parent company keeps the remaining stake. Once the part starts trading independently, the market is forced to assign it a clear value. And once that happens, investors can finally isolate what the rest of the parent company is being valued at. This is where simple subtraction reveals hidden value. To understand how this works, let's look at a real life case study. Let's talk about shares. At the time, Shears was large, well-known company. Nothing it owned was a secret. Shears owned a large US department store business, foreign retail operations, mainly Shears Canada and Shears Mexico, a real estate business including Coldwell Banker, Allstate, a major insurance company, Dean Witter, which included the Discover credit card business. All of the information was public. So the obvious question was, if everyone already knew this, Why would this ever become an opportunity? The turning point. In September 1992, Shears announced that it would sell 20% stake in Dean Witter and Allstate to the public. Management believed that the value of the business was not being properly reflected in Shear's stock price. More importantly, Shear also announced that it plans to distribute its remaining 80% stake in Dean Witter directly to shareholders at a later date. This was critical. For the first time, these businesses would trade independently, forcing the market to assign appropriate price tags. Price before distribution. By mid 1993, just before the Dean Witter distribution, share stock was trading at $54. Dean Witter at $37. Allstat at about $29. Now the math begins. Okay, Share distributed 136 million shares of Dean Witter. Shares owned about 340 million shares, had about 340 million shares outstanding. That means for every one share of shares, shareholder received zero point 0.4 shares of Dean Witter. That is nothing but 136 million divided by 340 million, we get 0.4. Okay. At $37 per share, the distribution was worth $15. How did we get $15? $37 into 0.4, you get $15. So if shares was trading at $54 before the distribution, after removing Dean Witter, the remaining share stock was effectively priced at $39. Okay. What did this $39 represent? The $39 represent everything still inside shares. The remaining 80% stake in Allstate, the US department store business, foreign retail operations, and all the other businesses that we saw previously. Then shares, let's subtract Allstate's part. Shares owned approximately 340 million shares in Allstate. Shares itself had approximately 340 million shares outstanding. 340 million divided by 340 million, which gives you 1. So if you own one share of shares, you indirectly own one share of Allstate. Allstate was trading at about $29. So from earlier calculated $39, if you remove this if you subtract $29, you get $10. What were you getting for $10? For $10, you were getting US retail business, Shares Canada, Shares Mexico, real estate asset including Coldwell Banker. Breaking this down further, international retail was worth about $2 to 3. Real estate was worth about $2 to 3. That led roughly to $5 per share for the core US retail business. The retail check. Okay. The retail business will check now. Okay. Share had about $27 billion in sales and roughly 340 million shares outstanding. That's about $79 of sales per share. How did you get it? 27 billion divided by 340 million shares. Okay. If the market was valuing the business at approximately $5 per share, you were effectively buying it at about 6% of sales. Comparable retailers were trading in the market at over 50% of sales. That wasn't prediction. That wasn't a forecast. It was structure forcing the mat in the open. Okay. What happened next? Over the following months, share stock rose by roughly 50%. Allstate moved only modestly. The market finally recognized the value of the remaining shares business.
Now, I would like to continue and explain what are merger securities. Merger securities are more manageable investment strategy for individuals. These involve different type of securities such as bonds, warrants issued during an acquisition. Investors often undervalue these securities due to their reluctance to hold something outside their core investment focus. Individuals can capitalize on this by purchasing these undervalued securities and profiting when the large market catches up. So now let me take an example of super right foods and explain what and how to look at an merger. Now, before the deal, Super Right Foods was a small grocery chain that nobody cared about. The company had about 5 million shares outstanding, and the stock was trading at $7 per share, giving it a market capitalization of $35 million. This is important because small, boring companies are where mispricing usually survives. Now, the merger announced and the deals were the Super Right announced an all cash merger at $9 per share. So the total value was $5 million multiplied by $9 million, making it $45 million. At this point, if the deal was successful, the outcome was fixed. Shareholders receive cash and not stock. So even after the deal was announced, the stock did not trade at $9. Instead, it traded at $8. So the market was offering a $1 spread on the deal that was already signed. That's a 12.5% return simply by waiting. This is where Greenwald says the market is being not intelligent but being patient. So now let's calculate the time adjusted or the time based returns. Assume that the deal closes in 6 months. So if you buy at $8 and in 6 months you receive $9, that's 12.5% in half a year, which is annualized to 25%. This has nothing to do with growth or forecasts or macro views. This is just pure arithmetic. Now, Greenwald never stops at upside. He always checks risk first. So if the deals fail, we look at the following things. Superite had inventory, store real estate, store real estate, equipment. So after subtracting debt, the net value was roughly $30 million or $6 per share. So the upside was $1 positive and the downside was negative $2. The probability of success was very high. This is a favorable arithmetic spin-off. Now, why the opportunity existed? Institutions ignored this deal because the company was too small, liquidity was low, and returns looked too boring. This is exactly the advantage Greenwald talks about. Now, let's understand the final takeaway. The Superite Food case shows us you don't need to predict the future to make money. You need to read the deal, do the math, compare the prices of the outcome. And as Greenwald teaches us, when securities are simple but ignored, returns can be extraordinary. Now, I want to take us forward to the next topic, which is called the risk arbitrage. Risk arbitrage, often associated with buying shares of companies involved in announced mergers, is not as foolproof as someone might think. An arbitrager buys shares of a company like Company B, which is said to be acquired by Company A at a premium price, creating a spread that arbitrager hopes to profit from. Despite the lure of quick profits, risk arbitrage carries significant risk. Now, the first is deal risk. Mergers can fail due to regulatory, financing, or due diligence issues, causing the shares to drop back to their pre-announcement values. Now, the second is timing risk. Mergers can take a long time, and any delay can affect the profitability. With many firms now observing and participating in risk arbitrage, competition has increased, making it hard for individual investors to achieve significant returns. Let us take a case study to understand this. The case study of Florida Cypress Gardens and Harcourt Brace, an early investment by the author. This merger involved the acquisition of Florida Cypress Gardens by Harcourt Brace. With a favorable shareholder structure and an appealing buyout price, arbitrage prospects look strong. However, complications arose when Cypress Garden fell into sinkhole, highlighting the unpredictability of a risk arbitrage. Ultimately, after a lengthy process, the deal closed with a minor losses for the author, emphasizing that risks can often overshadow potential rewards. Despite the initial opportunity, the risk arbitrage landscape is dwindling due to increased competition and reduced spreads in potential profit. Higher risk and lower stability makes arbitrage less appealing for individual investors. Unlike risk arbitrage, merger securities are more manageable investment strategy. So according to our author, risk arbitrage are a big no, whereas mergers are always much safer in comparison to them.
Hello everyone, my name is Shlok Singh and I'll be speaking on bankruptcy investing. Bankruptcy can offer opportunities but is very risky. Many bankrupt companies' securities are mispriced, but not all are good investments. So why do companies go bankrupt? There are many reasons which are excessive debt, examples from buyouts. Second would be poor management or over expansion. Third would be lawsuit or industry treaties. When an opportunity often arises, if a good business fails due to debt and not poor performance, one should take it. So why buying a stock in bankruptcy is a bad idea? Shareholders are last in line to get paid. Old stockholders usually get little or nothing, and despite this, stocks are often traded at inflated prices. Avoid buying stocks in companies still in bankruptcy. Which are the better options would be distressed bonds, bank loans, and trade claims. But these are a complex and best for specialist investors. So which is the best time to invest? That is after bankruptcy. Once the legal issues are resolved and the company's new capital structure is clear, the creditors sell their new stock quickly, leading to mispricing. Why stocks are mispriced? Forced selling by creditors, no Wall Street attention, and stigma from bankruptcy. These stocks are often called as orphan equities. What are the evidence of this opportunity? Stocks from bankrupt companies outperform the market by 20% plus in the first 200 days. Smaller companies showed the strongest return. So, how to pick the right ones? Good businesses with strong positions, bankrupted by debt and not bad products, and undervalued but with manageable risk. Moving on, the case study we will be studying is about a company that went bankrupt in 1992. Had its stock selling for about $7. Looked risky and unpopular, but later tripled to about $21. The investor bought it cheap, sold it after recovery, and made a lot of money, even though the business itself was never great. What kind of company was this? This was the Charter Medical Corporation, which operated 78 psychiatric hospitals and 10 regular medical hospitals, in total 88 hospitals. This made Charter one of the largest psychiatric hospital operators in the US at that time. So, why did the company get into troubles? Insurance companies cut hospital stays. So, in 1998, average patient stayed 30 days in the hospital, and by 1992, the average stay dropped by to under 20 days. That's a 33% reduction in the stay length. Since hospitals are paid per day, this meant roughly one third less revenue per patient. Another reason would be too much of debt. So before bankruptcy, the debt of the company was around 1.6 billion, and after the bankruptcy, the debt was reduced to $900 million. So even after a cut of 900 million, even after a cut, the $900 million was still a very large amount, especially for a business under pressure. What did bankruptcy change? Bankruptcy did not shut the company. Instead, debt dropped by approx $700 million. Lenders took most of the company's ownership, and old shareholders were diluted to a very small stake. This saved this saved the business but scared the investors away. Why was the stock price so low? So after the bankruptcy, stock price traded between $4.75 to $8. And in December 1992, it was around $7. Other similar hospital companies traded to close to around $15 per share. So Tata was priced at less than half of similar companies. So why did the investors think $7 was cheap? So the company was producing real cash. That is, the charter was expected to generate 2.5 to $3 per share in free cash each year, compared to the $7 stock price. That's a 35 to 43% of the stock price every year in cash. In simpler terms, if nothing went wrong, the company could earn back its entire stock price in about 3 years. The cost and operations were improving. After bankruptcy, costs were controlled. Patients' admissions increased. Outpatient services, which were in the cheaper care, expanded. These changes helped offset the shorter hospital stays. Managers had the money on the line. That is, the company insiders owned a large amount of stocks and options. And if the stock laid low, managers would lose money. So, what was the risk? Despite the improvements, debt was still at around $900 million. Industry pricing was controlled by the insurers, and one bad year could cause serious problems. This was not a safe investment, it was a calculated risk. What actually happened after the purchase was that over the next year, costs stayed under control. More patients came in. Company sold its 10 regular hospitals for a good price, and the Wall Street started paying attention. As a result, the confidence returned. The stock price rose from $7 to $21. That's a 200% gain. So why did the investors sell at $21? The stock was no longer cheap. It had already matched or exceeded the peer valuations. The investor locked in the gains, and if they had held on, they would have produced little or no return over the next 3 years. So why? So the reason for not returning any return in the next 3 years would be that the patient stay was still short, which is under 20 days. Insurance companies stayed in control. The growth stayed limited, and once the recovery story ended, there was no reason for the stock to go high. The simple lesson that we learned is what worked. Buying at $7 and selling at $21 and benefiting from the temporary recovery. What wouldn't have worked? Holding a heavily indebted company in a shrinking industry. The Now, on the last thing, what are the key takeaways? Sell once the event driven mispricing is recognized. Hold quality businesses for long term growth and trade the bad and invest in good. Good company stocks are like with strong brand and franchise like Amex and Lee. Thank you.
Hello, my name is Parth, and I am going to explain corporate restructuring not in a technical or textbook way, but in a way that anyone can understand. Most people hear the word restructuring and immediately think of trouble, losses, debt, or companies in distress. But from an investor's point of view, restructuring can actually create some of the best opportunities in the stock market. To understand why, we need to clear about what restructuring really means in investing. In investing, restructuring does not mean small changes like cost cutting or renegotiating loans. It means big structural changes to the business itself. This could involve selling a major division, shutting down a large loss making segment, or exiting an entire line of business so the company can focus on what it does the best. The key idea is very simple. Sometimes a weak or boring business inside a company hides the value of a good business. When that weak part is removed, the true value of a company becomes visible to the market. Let me explain with a simple numerical example. Imagine a company has three divisions. Of the first division earns 3 rupees and the second earns 2 rupees, and let's say third division losses 2 rupees. So the total earning of a company are 3 rupees. Suppose the stock is trading at 30 rupees, which means the company is valued at 10 times the earnings. Now imagine the company shut down the loss-making division. The remaining two divisions together earn 5 rupees, but the stock price is still 30 rupees. Suddenly the valuation drops from 10 times earnings to the 6 times earnings. Without any growth or improvement in sale, nothing magical happened. The company simply removed a bad business. This is how restructuring value unlocks value. There are two ways investor can benefit from restructuring. The first and the easier way is to invest after restructuring has already been announced. When a company publicly says it plans to sell or shut down a major business division, the market often takes time to fully understand the impact of that decision. During this period, investors still have opportunity to benefit. The second way is more difficult. This is when investors believe restructuring might happen in the future, even though it has not yet been announced. In these cases, a weak business is clearly dragging down a stronger one, and management may eventually act. However, this approach requires more patience because restructuring can take time or may not happen at all. A good example of this idea is the case study of Greenman Brothers. Greenman was a small boring company whose main business was wholesale distribution of toys and stationery. It was barely profitable and attracted little attention from the stock market. Because of this, the stock was cheap. However, hidden inside this dull company, there was a new business called Noodle Kidoodle. Noodle Kidoodle was a specialty retail store focused on educational toys for children. The stores were very well designed, popular with customers, and had a strong growth potential. Despite this, the market continued to value Greenman only as a boring distributor and gave almost no value to retail business. To expand Noodle Kidoodle across the country, Greenman needed money. At the same time, its distribution business was performing poorly but had assets that could be sold easily. Eventually, a company announced that it was exploring the sale of distribution X business so it could focus only on Noodle Kidoodle. This decision was corporate restructuring. Once this was announced, the market's perception of Greenman changed completely. It was no longer seen as a slow distributor but as a growing retail company. As a result, the stock price moved sharply upward and hidden value was finally recognized. The key lessons from this are very clear. Corporate restructuring in investing is about changing the business mix, not just fixing the balance sheet. Selling or shutting down a weak business can dramatically improve how a company is valued, and the best opportunity is exist before or just after restructuring is announced, when the market has not fully priced in the change. In investing, you don't make money simply because restructuring happens. You make money because the market underestimates how much value that restructuring will unlock. Greenman Brothers shows us that sometimes doing less business but the right business can make a company far more valuable.
So now I'm going to discuss few current affairs that are going on. Now let's talk about tariffs. The dominant theme over the past month has been the structural weaponization of global trade. Tariffs are no longer tactical tools. They have become a permanent policy lever, with the US average tariff jumping from 2% to nearly 17% in 2025, and India facing effective tariffs as high as 50%. This shift has real economic consequences. Export-oriented clusters like Tripur have already seen 15,000 crore in order losses, highlighting how tariffs now transfer directly into jobs and production. At the policy level, India is responding defensively through import price floors, safeguard duties, and diversification of export markets, while also pushing back at the WTO. Despite the short-term resilience in exports, currency pressure and earnings uncertainty remain key risks. Overall, this marks a transition to a more fragmented, protectionist global trade regime where policy risk is now core macro variable. When we analyze market drift over the last month, the key takeaway is selective strength, not broad participation. While headline indices moved higher, a large part of the market failed to keep pace, with nearly 60% of the top 1,000 stocks delivering negative returns despite record index levels. This tells us the rally was concentrated in a narrow set of large cap and defensives, rather than being earnings led across the market. Breadth also deteriorated during periods of foreign investor selling, indicating that domestic liquidity alone struggled to support the broader market. Small and mid-cap stocks remained under pressure, highlighting risk aversion beneath the surface. Overall, this is a liquidity-driven, fragile market structure where returns depend on stock selection rather than index direction.
The first topic I'll be speaking on is the PLI, which is the production linked incentives are designed to boost local manufacturing and reduce import dependence across sectors like automobiles, textiles, electronics, and pharmaceuticals. The first is automobile and auto components. Outlay is across 5 years, which is 25,938 crore rupees. Approval of 82 out of the 115 applicants, including OEMs. Criteria 125 crore in sales in year one, 10% annual growth, and 50% domestic value addition. The current status as on Jan 2026 is only 12 out of the 82 met the DVA target, 12 failed the investment requirements. The criticism in the market, the startups say that the scheme favors large players due to the high threshold. On to the textile. The deadline extension, the applications are now open until 31st March 2026. The focus is on MMF apparel, MMF fabrics, and technical textiles. Investor sentiment is that is that the sector is growing. Electronics, which is the PLI 2.0, the focus shifted from the year-end products to electronic components and intermediate goods to reduce the reliance on Chinese imports. On to the pharma, the MIP on pharma imports, example of potassium at $180 per kg is to prevent dumping. And the WTO and in WTO, China is challenging India's solar PV module PLI at the WTO forum. On to the GDP, India's economy is now the world's fourth largest economy with a GDP of $4.18 trillion, surpassing Japan. The government targets $7.3 trillion by 2030, aiming to become the third largest economy. The recent growth and projections, the Q2 25-26 GDP, 8.2% growth. With 8.2% growth, FY26 growth expected over 7%, surpassing earlier estimates of 6.5%. The growth deceleration anticipated slowdown in the second half of the FY26, with growth moderating to 7% in FY27. The nominal growth at 8.8% for the first two quarters, missing the budget assumptions of 10.1%. The key economic indicators are the market cap to GDP surged to 100% plus, reflecting formalization. debt to GDP aiming at 54.5 to 55% by FY27, with a long-term target of 50% by FY31. The state level economic growth, Uttar Pradesh aiming for $1 trillion economy with GSDP rising from 13.3 trillion rupees to 30 trillion today, targeting 35 trillion by FY26. The Assam GSDP expected to reach 7.42 trillion rupees in FY26. And in Rajasthan, the tourism contributes 12% of its GSDP, 2.5 times the national average. The GDP calculation methodology update. The new series scheduled for Feb 2026 introducing double deflation for more accurate GDP calculations with improved data from PLFS and GSTN to better capture the informal economy. On to the last topic, which is the India's 2025 rate cuts ripple. The repo rate cut was 125 base points in 2025, reaching 5.25%. Impact, the lending rates reduced by 69 base points. Union Bank cut retail rates by 160 base points and LIC housing to 7.15%. Deposit rates fell by 105 base points. Peak deposit rates lowered to 6.45%. Challenges, small saving rates held steady at 7.1%, limiting the further deposit rate cuts. On to the global, what is the economic impact? Boosted automobile sales and housing affordability. Bond yields stayed elevated due to state borrowing and liquidity issues. The future outlook is that the few expect more cuts with less than 50% chance of another in Feb 2026. Global context, US anticipated two or more quarter point cuts in 2026. Europe, ECB holds at 2%, and in Japan, raised the rates to 0.75%. Thank you.
So now I'll talk about recent IPOs. The Indian IPO market has remained exceptionally strong and structurally important, emerging as one of the most active globally. In calendar 2025, India recorded a IPO cycle with around 370 IPOs across main board and SME platforms, raising close to 1.95 lakh crores, driven largely by strong domestic liquidity and retail participations. Financial service, consumer facing business, manufacturing, and technology led companies dominated fundraising, while the SME segment continued to see board based participation, reflecting deepening capital markets. All through subscriptions levels and listing day gains were strong across many issues. Post-listing performance has been mixed, highlighting a shift from momentum-driven participation to more valuation-sensitive investing. Heading into early 2026, the pipeline remains healthy, with notable names such as Amagi Media Labs preparing a sizable IPO and expectations building around the potential mega listings like Reliance Jio, which could become one of the India's largest ever public offering if it proceeds. From a market perspective, the sustained IPO activity signals confidence in India's macro fundamentals, supported by GDP growth, stable financial condition, and robust equity markets. However, the current phase also reflects increasing selectivity, where quality of earnings, business durability, and pricing disciplines are becoming critical for long-term returns. Overall, the IPOs market is transitioned from a cyclical surge to more mature, broad-based capital raising platform, reinforcing its positivity as a and position as a destination for global and domestic issuers alike. So now I'll talk about China Plus One. Over the past few months, China Plus One strategy has accelerated and India has emerged as a key structural beneficiaries. China Plus One does not mean an exit from China, but a diversification of supply chains driven by geopolitical risk, export control, and need for resilience. This shift comes to favorable time for India, with 2026 GDP projected around 7.4%, supported by strong domestic demand, public capex, and rising manufacturing activities. As a result, India is attracting incremental investments across electronics, EMS, chemical, pharmaceuticals, and auto components and renewable energies. However, challenge remains India's trade deficit with China widened to about $106 billion in 2025, reflecting continued dependence on imported electronics, machineries, APIs, intermediaries, which highlights the need for deeper backward integration rather than just assembly-led growth. From a market perspective, China Plus One has created selective winners such as EMS, capital goods, logistics, and industrial manufacturing, while input dependent sectors like pharma and chemicals remain sensitive to pricing and geopolitical risk. Overall, China Plus One is shaping up a multi year structural theme for India, strengthening manufacturing, influencing sector leadership in equities, and gradually reducing supply chain concentration risk, even as China remains as an important but no longer dominant partner.
Now, let's discuss on AI. AI in India is no longer a premium or a niche product. It has become a mass consumer utility. ChatGPT's daily active users in India jumped approximately 607% year on year to about 73 million users. Google Gemini crossed approximately 17 million daily users, with usage rising about 15% after bundling. Reliance Jio bundled Gemini, giving AI access to approximately 505 million users. Airtel bundled Perplexity for approximately 350 million users. This has never happened before with any general purpose technology in India. AI is now free, and that changes everything. Because AI is bundled with telecoms and platforms, users are no longer paying directly for AI. That creates a structural shift. AI companies lose consumer pricing power. SaaS, EdTech, and subscription businesses face pressure. Value shifts away from app towards infrastructure and enterprise integration. AI stops being a product and starts behaving like a digital plumbing. Enterprise adoption is high, but value is missing. Now, contrast consumer scale with enterprise reality. Okay? Approximately 90% of enterprises say they are using AI, out of which only 7% have actually scaled AI use cases. Approximately 95% reports no meaningful return on investment from generative AI. AI is everywhere, but it's not deeply embedded. Why this AI valuation gap exists? Why this AI value gap exists? Most companies made the same mistake. They used AI as a co-pilot, not as a redesigning tool. AI was layered on top of a workflow. Tech was upgraded, but work wasn't restructured. Governance, data ownership, skills, accountability were underestimated. Real AI value only comes when workflows are redesigned end to end, decision rights changes, and human and machine operates as one system. This is slow, organizationally painful work, which is why most firms haven't crossed the gap yet. Capital knows where the real value is. Despite weak enterprise return on investment, capital is flowing hard. Microsoft committed approximately $17 billion to AI and cloud in India. Amazon committed approximately 35 billion by 2030 after an earlier commitment of $12.7 billion. India's IT index rose approximately 6% in 1 month on AI revenue expectations. Investors are no longer betting on chatbots. They are betting on compute, enterprise workload, and long-term pricing power. The AI narrative going to 2026. Near-term AGI expectations have been pushed out by at least a decade. That focus has now shifted to agentic AI. AI system that executes tasks, coordinate workflows, and works alongside human. Less flashy, but far more economically valuable. Coming to currency depreciation. Whenever the rupee depreciates, markets panic. The instinctive reaction is simple. Weak rupee equals to weak economy. That thinking itself is wrong. Currencies are not report cards. They are shock absorbers for trade flows, capital movement, and inflation differences. In the current global environment, a measured rupee depreciation is not just inevitable, it's necessary. What's different this time? Usually, rupee panic happens when the US dollar strengthens globally and all currencies fall together. In that case, India's relative competitiveness barely changes. But this time, the rupee has weakened not just against the dollar, but also against the euro, yen, yuan, pound. So, that is not a dollar story. That is a broad based depreciation against India's trading partners, and that directly affects competitiveness. The real signal, that is NEER and REER, that is nominal effective exchange rate and real effective exchange rate. To understand what's happening, forget USD INR. India tracks two indices with 2015-16 is equal to 100 as the base. NEER, that is trade weighted nominal rupee, and REER, that is NEER adjusted for inflation. Current level of NEER is approximately 84.6 and REER is approximately 97.5. For years, India's REER stayed above 100, meaning the rupee was overvalued. Now it's below its long-term average. That means India's goods are cheaper globally after inflation. Exactly what experts need. Why REER matters more than USD INR. India doesn't trade with one country. That's why the Reserve Bank of India focuses on REER, that is real effective exchange rate. When REER falls, exports become competitive. Imports become costlier. The current account corrects naturally. So even if USD INR looks uncomfortable, a falling REER can actually be healthy. Now let's talk about China's pressure. China is facing deflation and excess capacity. India's trade deficit with China and Hong Kong has doubled. $58 billion pre-pandemic, which is now at $114 billion in 2025. The rupee is down approximately 15% nominally against the yuan. But because China is in deflation, India's real exchange rate versus China has appreciated approximately 10%. That makes China imports cheaper and hurts Indian manufacturers. Letting the rupee weaken against the yuan is defensive competitiveness, not mismanagement. This kind of depreciation does not threaten stability. It works like external monetary easing.
Let's discuss about the economic indicators. On the growth and output side, the economy is being supported by three engines working together. First, urban consumption remains resilient, driven by stable incomes and service-led demand. Second, manufacturing is benefiting from government-led infrastructure spending, supply chain diversification, and improving capacity utilization. Third, private investment is gradually picking up as balance sheets have strengthened and visibility on demand has improved. When we move to sentiment and activity, the strength is largely forward-looking. Businesses are reporting healthy order books, improving pricing powers, and better utilization of existing capacity. Service activity is being driven by travel, hospitality, financial services, and digital demand, while industrial output reflects the lagged impact of earlier capex and infrastructure execution. Overall growth is being driven by real demand and execution, and sentiment is strong because firms are seeing this momentum sustain and not fade.
I will be continuing from here on. Let's break down the India's inflation for November, December, and Jan 2025-2026. Headline CPI inflation is at 0.7% due to sharp drop in vegetable prices. This kept the overall consumer prices low as food prices fell significantly. Core CPI inflation is higher at 4.3%, driven by high gold and silver prices. Non-food and non-fuel inflation remains elevated due to these costly metals. Core CPI excluding gold is at 2.4%, showing a more moderate inflation rate once we exclude the impact of rising gold prices. Wholesale price inflation WPI is negative at minus 0.3%, mainly due to falling crude prices and food prices. This deflation at the wholesale level is easing cost pressures for producers. In short, headline CPI is low due to falling food prices. Core CPI is high due to gold and silver prices. Core CPI excluding gold is more moderate, and WPI is in deflation, helping ease producer cost. Thank you.
India's fiscal position this year shows a continued emphasis on supporting economic growth through front loaded spending, even as revenue pressures remain challenging. According to latest official data, the central government fiscal deficit widened to about 9.77 trillion in April to November of FY26, equivalent to roughly 62.3 of the full year budget estimate. This widening reflects a combination of slower tax buoyancy, with gross tax revenue growing mildly and not keeping pace with nominal GDP, and a strong push on capital expenditure, which has risen sharply as the government accelerates spending on infrastructure such as roads, railways, and utilities. Revenue expenditures, meanwhile, has been kept largely under control, allowing government to prioritize investment without proportionately increasing routine outlays. The subdued revenue performance stems in part from policies decisions like personal income tax rate cuts and GST rationalizations, which have tempered tax collection as well as weak response to taxes growth. The result is a fiscal stance that remains expansionary on investment front while fiscally disciplined on everyday spending, supporting medium growth even when headline of deficit appears elevated in the first 7 months of year. Overall, this point to be deliberate strategy of balancing growth support with fiscal prudence, and markets will be watching how tax receipts improve and spending patterns adjust through the reminders of 2026.
Now, let us take a look at some more indicators. In November 2025, India's gold imports collapsed by 59 to 60% year on year to about $4 billion. This was driven by high prices and weak post festival demand. This sharply narrowed the trade deficit. In April to November, gold import rose to $45.26 billion, mainly due to price effect, not higher volumes. In quarter 2 FY26, the current account deficit was $12.3 billion, with gold import of $19 billion, being the only real drag. Excluding gold, which is more of an investment asset rather than a consumption, and normalizing for festival seasonality, India actually ran a current account surplus of about $6 billion. On this basis, India has posted a current account surplus in 10 of the 11 quarters, last 11 quarters. Let's talk about FPIs. FPI stayed a net seller in December with rupees 22,600 crore of equity outflows and rupees 15,000 crores of debt selling, making it a weak month overall. For 2025 as a whole, equity outflows hit a record of rupees 1.66 lakh crores, partly offset by rupees 61,000 crores of debt inflow. FDI also showed net outflow of $1.5 billion in October for the third straight month, but this was driven by profit repatriation and outward investment by Indian firms, not a fall in fresh inflows. Let's talk on trade. On trade, November export rebounded strongly. Merchandise export rose 19.38% year on year to $38.13 billion, led by engineering goods, electronics, gems and jewelries, petroleum products, and pharmaceuticals. Service exports grew 11.67% to $35.86 billion, lifting total export by 15.52%. Meanwhile, imports fell 1.9% to $62.7 billion, mainly due to lower gold and crude oil, despite higher electronic and machinery imports, which narrowed the trade deficit to $24.5 billion, which was better than October. Bank credit growth stayed at 11.5% in November, driven by MSME service, especially trade and retail loans. Headline personal loan growth was 12.8%, but this was inflated by gold-backed lending. Excluding gold loans, retail credit slowed to about 9.6%. Talking about industrial credit improved to 9.6% from 8.3%, led by MSMEs with double-digit growth in engineering, petroleum, and textiles, pointing to a broad-based recovery. Service credit remains strong at 11.7 to 12.8%, supported by trade, consumption, and working capital demand. Retail credit was supported by RBI rate cut in 2025, while rising bank lending to NBFCs showed better liquidity transmission. Monetary policy remained supportive. After a 25 basis point rate cut on December 5th, the repo rate is 5.25% with reverse repo at 3.35%, MSF at 5.5%, and SDF at 5%. Set in the December 2025 MPC meeting, that is Monetary Policy Committee meeting, to support growth while maintaining financial stability. Thank you.